Thanks for clicking. All eyes were on the Bank of Canada yesterday morning as it was set to make its interest rate announcement, with the majority of economists predicting the bank would be pausing on its path of interest rate hikes. We got our answer at 10 a.m. yesterday morning when the bank announced it would be raising rates by 25 basis points, bringing the policy rate up to 4.5% and the prime rate up to 6.7%. The majority of the headlines following the bank's announcement showed a central bank that is intent on pausing interest rate hikes, intent on waiting to see the effectiveness of the 425 basis point in rate hikes that we've seen over the past year. But I think the real news came when the Bank of Canada Governor Tiff Macklem held a press conference following the release of the rate announcement, when he was asked about the bank's projections for our inflation rate, our economy, and our real estate market.
How f***ed up are you?
So what I want to do today is go over the bank's announcement, take a look at the press conference when the Bank of Canada was asked about the future of Canada's economy going forward, and then discuss what to look for next. Speaking of next, it is the end of the month, so January's real estate data should start trickling out from the local boards by late next week, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this rate announcement. As mentioned, the Bank of Canada raised interest rates by 25 basis points yesterday, bringing Canada's policy rate up to 4.5%. The bank signaled that it would be pausing rates, at least for now, but it did leave the door open to increase interest rates if inflation persists, if inflation remains sticky, or doesn't get down to that 2% target over the next year. And the Bank of Canada governor had more to say on this position at the press conference.
With today's modest increase, we expect to pause rate hikes while we assess the impacts of the substantial monetary policy tightening already undertaken. To be clear, this is a conditional pause.
So long as the CPI continues to come down, so long as Canada's inflation rate continues to slow, the bank will keep with its pause. But if inflation remains sticky, if prices don't continue to slow, then the bank may have to raise interest rates further. But the governor says that the interest rates that we've seen over the past year are indeed working.
Household spending has moderated. Demand for furniture and appliances has decreased, and housing market activity and prices have declined substantially.
You treat me like I was never nothing to you.
And, says the governor, this slowdown in demand will slow down the economy in 2023.
Higher interest rates are also expected to continue to slow business investment, and weaker foreign demand will weigh on exports.
And I think this is a good point coming from the governor. Canada is not the only one raising interest rates. The Federal Reserve is set to raise rates over 5% by the time it hits its terminal rate. And a slowdown in the United States, our biggest trading partner, will definitely have an impact on our economy here. As such, the governor said that Canada should see a major slowdown in its economy in 2023 and return to a 2% growth rate by 2024.
We project that on an annual average basis, growth in Canada's GDP will slow from about 3.5% in 2022 to about 1% in 2023 and 2% in 2024.
And this slowing demand, combined with lower gas prices and improved supply chains, says the governor, should bring Canada's inflation rate back down to 3% by the middle of this year.
Lower energy prices, improved global supply chains, and slowing demand should bring inflation down significantly this year.
With that said, there is a concern on behalf of the Bank of Canada that higher energy prices, combined with inflation expectations, and here's the big one, higher wages, could push our inflation rate up even higher going into 2023.
The biggest near-term risk is that global energy prices could increase, pushing inflation up globally. We're also concerned that if inflation expectations remain elevated in Canada or increases in labor costs persist, inflation will not come down as quickly as we forecast.
And the governor says that if these risks materialize, if energy prices go up, if expectations don't come down, and if wages continue to go up, then the Bank of Canada may have to consider continuing to raise rates.
With inflation still well above our target, we continue to be more concerned about the upside risks. And if these upside risks materialize, we are prepared to raise interest rates further.
Don't do this to me. Don't push me to edge.
And this is somewhat concerning. As we've talked about before on this channel, gas prices are almost impossible to predict. And with China coming back online, many are predicting record high oil for 2023. But the wage pressures, I think, is the real important message coming out of the Bank of Canada. Wage pressures have been on the rise in Canada for the past year, as Canadians attempt to recoup some of their losses due to the higher cost of goods. However, the Bank of Canada, as we've talked about, does not want to see a wage price spiral. It doesn't want to see employers give wage increases, take the cost of those increases, push them onto the consumer, which pushes up the price of goods, which leads to more wage demand. So the Bank of Canada, as we've talked about before, is very much trying to induce a recession, trying to lower the bargaining power of workers. If there are 10 workers and only 5 jobs available, those 10 workers aren't going to have much bargaining power, and this will put downward pressure on wages. If this doesn't happen, if the Bank of Canada sees wages continue to go up as workers try to recoup their losses, then the bank will have to raise rates again.
You get one way or the other.
Speaking of which, the governor was asked point blank if we should expect real estate prices to continue to decline.
NPR said that the bank expects house prices to decline further, especially in markets that were red hot. Does the bank have an expectation of what the magnitude of house price declines will ultimately be, whether it's 20% or 30%? And
the governor deferred to Senior Deputy Governor Carolyn Rogers, who said that we should expect prices to continue to come down for some time.
Housing markets evolved broadly in line with our expectations. As you've mentioned, it's come down, activity's come down significantly, and prices have come down as well. It's important to remember they've come down off extreme highs. We saw a real run-up in prices and activity during the pandemic. That was an unsustainable level of activity.
Says you.
In fact, Rogers says that prices should continue to come down for the first couple of quarters.
Then we do expect, as we outline in the NPR, that pullback will continue in the first couple of quarters.
And this is definitely news for some. As we've talked about on this channel, many of the predictions out there have said that we're going to see Canada's real estate market bottom in the spring of 2023, with the CREA saying that the impact of the rate hikes are probably in the rearview mirror, and the buyers will be returning to the market in the spring. But this isn't what the Bank of Canada is saying. The Bank of Canada thinks that it's going to be a few quarters until we see real estate prices bottom out, until we get to that sweet spot.
But we do think there is a little bit further to go for the housing market to come down a bit.
So, in summary, the Bank of Canada is pausing for now. And I think that needs to be the message. Not that the Bank of Canada is pausing and we're through this thing. It's that they're pausing for now. They're waiting to see the impact of the interest rate hikes that we've had for the past year and what they do to the economy. There are a number of uncertainties out there which the Bank of Canada has said explicitly they will raise rates if these do not materialize in the manner in which the bank is hoping. If gas prices come up, which they very well might with China coming online, if wages continue to go up, if workers are able to recoup some of those losses that stem from an increase in the cost of goods, then the bank may consider continuing to raise rates. If that recession doesn't hit, if that recession doesn't materialize, the Bank of Canada will be raising rates going into the future. So the bank has paused for right now, but it's definitely a tentative pause. It's definitely a pause with some caveats. We're not out of the woods just yet. With that said, we will continue to track developments coming from the Bank of Canada and Canada's economy, and of course, Canada's real estate market on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.